A very warm welcome to all investors present here today. The most anticipated event is here, hosted by CIO Mojo PMS, Mr. Sunil Damania, and founder Dr. Mohit Batra. Will gold and silver extend their winning streak? Are FPIs poised for a comeback? Is it the year for mid cap or small caps? And many other questions would be decoded live today. Over to you, Dr. Mohit.
Oh, very good evening to all of you. This is our annual event where we do some predictions. We will obviously go in and first check what happened to what we presented to you in the month of January 2025 as our view, overall view, and how's that view shaped up, where we've gone right, where we've gone wrong, and basis that we will form this year's view. But before I start, I must tell you a very funny incident, Sunil. I don't know if you know this, but yesterday when I was doing a webinar, I was continuously getting a call from my mother.
Okay.
Right, so I got one call, and obviously my phone was on airplane mode, but the Wi-Fi was on, and she was giving me a WhatsApp Wi-Fi call. So, and I didn't pick up. You know how old people do; they repeatedly call. Right? She called me 6 times.
Okay.
And then from the live webinar, I got up and I went out to speak to her. This is very funny. I must tell you this because this is how my parents perceive my time from 7 to 8 o'clock. So I said, हिंदी में बताता हूँ आपको. I said, हाँ मम्मा क्या? She said, बेटा क्या कर रहा था? I said, webinar में था. So he got very worried because every day from 7 o'clock onwards, I tell her that मैं webinar में था. So she said, business ठीक नहीं चल रहा है क्या बेटा? So I said, नहीं मैं तो वेबिनार में क्लाइंट्स के सामने जाता हूँ ना. तो she said 7-8 बजे क्लाइंट के सामने तू जाता है और अपनी बड़ी गाड़ी में क्यों नहीं जाता है? So I didn't get this. I said बड़ी गाड़ी मतलब what do you mean by बड़ी गाड़ी? He said तूने वैगन चलानी कब से चालू कर दी? So my webinar, she for the last 1 year has been understanding that I am going at 7 o'clock in a Wagon-R, trying to meet customers on the road, maybe to onboard them. You understand how my mother thinks I am a hardworking child, trying to go every evening, not in my luxurious car, but in a Wagon-R, and trying to onboard customers. So I had a very good laugh yesterday, and I explained her that webinar means video. It is not, webinar is not Wagon-R. It's a video. From today, I will call it as a video conference that I'm doing with my clients, at least to her. With that note, I had a good laugh yesterday. I hope it was entertaining to you as well. Wish you all a very, very happy new year. From both me, Sunil, and the whole family of MarketsMojo. Wishing you all a very, very happy new year. This coming year, we have a very solid hypothesis that we've laid out today in terms of what the markets can do in this particular year. With a full disclaimer that this is an internal view. More say at certain point in time, I would say this is to an extent somewhere Sunil's view, because my view towards the end changes a little. And so I have selectively decided to speak right at the end when he builds up the whole hypothesis so that I can then drill down or maybe drill into his hypothesis and try and poke holes, because
It's 100% my view. Let's put it on the record.
It is 100% Sunil's view. My view is a little different than this, which I will, without any fear, explain you why I'm saying that towards the end of the presentation. But overall, where the markets are going to move, the commodities prediction that we are doing today, the overall market prediction that we are today, both of us are completely in line with that. With that note, we will start the presentation. The first half of the, or maybe first 3/4 of the presentation, Sunil will do. And then in the last 1/4, I will try and do as much destruction as I can onto his hypothesis. With that note, let us start.
Thanks a lot, Mohit. I think.
Do you want to say something in your defense first?
No, I don't need any defense because first
Oh
let
my
the attack
God.
comes and then the defense would be there actually. So the life is all about probability. So first a disclaimer as usual. This webinar is only for the information purpose. Please consult your financial advisor before buying and selling any stock. Investment securities market are subject to market risk, and past performance is no guarantee for the future returns. So very quickly, I'll go through our scorecard on the prediction. So we have a very bad habit, this is not the 1 year we are doing. We always do it. What we predicted last year, what happened, and that gives us a complete report card for us whether we have gone right or we've gone wrong. Actually, it's always good to present the report card. It also helps us to reassess where we went wrong, where we went right, and how can we further improve on our prediction so that it helps us to give a better this one, because learning is something which should never stop in life, and that's exactly what we keep doing it. So that's in fact MarketsMojo, when we started, we had a very huge debate and discussion when we started our Mojo stock, and there was a one school of thought that we should only put Mojo stock which has performed well, and I insisted that we should put complete list of all Mojo stocks whether we've gone right or wrong, and let the people assess, because they also create a pressure on us that if we are not doing well, we can take a corrective actions kind of a stuff. So here is a report card with the clear cut that some places we have gone right and some places we have gone terribly wrong in that case. And of course, then we will go into the prediction mode of 2026. So on 3rd January 2025, when I came in front of you, we stated with that market is going to go up purely because of Nifty giving a base case scenario of 10 to 20% return. And fortunately, market did give 10.5% return for the year. Now, these returns have been all back-ended for the very simple reason because the first half was extremely bad for the market. And I remember many of you did ask me in the month of Jan and Feb when market tanked because of tariff war, will this hypothesis will hold true? And I was of the opinion that it should logically, because the call that we have taken based on the historical return the Nifty has given, the valuation it is it's commanding, and we are also expecting the rate cut and so on and so forth. It was a culmination of all these factors. We did say that it will give return. Second thing, which was little controversial at that point of time, when we stated that mid and small cap will give the muted returns, and many of you was little of the different opinion for the very simple reason, 2023 and 2024 was all about mid cap and small cap returns, and hence how can the mid cap and small cap cannot give good returns? The reality of the life is that the mid cap index in 2025 hardly gave any returns, 1.1% return, and the small cap was actually down by 6.62% return. Of course, you would still have a question, will 2026 will be a little different as compared to what has happened in 2025. Of course, we'll try to touch upon that, and Mohit will take that heavy lifting in the later part of that. And of course, he will try to be in a little aggressive mode to defend what I'm going to say. We did say that inflation will move down in 2025 and RBI will do 75 bips rate cut. Just to give a perspective, in 2024, Fed did 100 bips rate cut, RBI did not do a single rate cut, which is a little unusual, am I right? And at that point of time, we did said that RBI will go a little aggressive and do 75 bips rate cut. And I remember I was talking to some of the fund managers at that point of time, and I said, Sudhil bhai, ho hi nahi sakta for the very simple reason because RBI has to protect the rupee, and hence don't expect a single rate cut. For even 75 bips to bahut zyada aggressive ho gaye. The reality of life is that not only the inflation did come down, and in fact we stated that the first rate cut will come on 7th Feb, immediately after the budget, and that exactly what happened. The first rate cut happened on 25 bips rate cut on 7th Feb, but RBI did go little aggressive and did 125 bips rate cut. One of the reasons why RBI had to do 125 bips rate cut, because in the month of July, August, US tariff got increased on India, and I think there was a support needed to keep the economy humming, and that's one reason RBI basically, instead of 75 bips rate cut, which we were expecting to do that, they did 125 bips rate cut. So in that place, even though our direction was right, I think the quantum of rate cut that we were expecting was little on the lower side. We said that 3 sectors should do well, BFSI, capital goods and FMCG, and this time I'm not going to repeat that because Mohit already covered the sectors that are going to do well, so this will not be part of our this presentation. So if you look at it, BFSI did well, the capital goods also did well, but the one sector that really disappointed us was an FMCG. Despite income tax rebate coming in, despite GST cut happening, despite 125 bips rate coming in from RBI, we did not see FMCG doing well. So that's where two sectors perform as our expectation, but of course the FMCG really disappointed us. We predicted rupee to touch 88 rupees with plus or minus one kind of a base case scenario. That's what we predicted, and eventually on 31st December, rupee did close 89.83. So again, we went little off this one, but very close to what we were. Now the question would come that rupee did touch 91. We said, so whenever we make a prediction, we said on the year end, what would be the rupee level by end of the year. That's what. So in between some volatility may happen, but we are talking about year-end numbers. So even for 2026, we are going to talk about the year-end numbers. Some in between there could be a volatility. We are not talking about that. And try to understand that so many variables that are there which are beyond our imagination and control. Like for example, in 2025, our house view was that, my personal view was that US may not go a little aggressive against India. But I think we and Brazil are the only countries who is paying 50% tariff. No other country is paying that kind of a tariff. And recently, Geeta Gopinath came out with the analysis which got published yesterday. We said the US average tariff is only less than 15%, but India is 50%. That also had its impact on the rupee. And of course, one basic assumption we made last year same time, that FPI to make near about 50,000 to 1 lakh positive inflow in the Indian equity market. That did not happen, and that also had its own impact on the rupee volatility, and hence our target, which was 88 plus or minus 1, it turned out to be 89.83 at the end of the calendar year. We stated that average crude oil price is expected to be $75 per barrel. So it was little high, and we expected crude oil price to come down. And some of you also questioned at that point of time, if Hamas-Israel war is on, if Russia-Ukraine war is on, it is not a very wise thing to expect crude oil prices to come down. And we did say that it is because it's ultimately a function of demand and supply. And that's exactly what has happened. The crude oil price, in fact, it surprised us on the positive side, why it came down to $69.40 per barrel. And one of the big reasons why that happened, because the OPEC Plus basically kept on increasing the production despite the prices were little low. In fact, these prices would have been much lower had China not been building up the inventory. In fact, in 2025, China has a good strategic reserve being built up on the crude oil side, and that's otherwise the price would have further gone down to our average price has been $69.40 as compared to $75. Again, the direction was right, but the quantum was much higher than what we were expecting it. Gold and silver should do well. Again, our direction was right, because we were expecting base case scenario 15%. The silver was 20%, and we all know the gold is up by 65% and silver is up by 148%. Never ever imagine that this kind of a gain would be made by both gold and silver. We were expecting strong FPI to come back in 2025. FPI investment was supposed to be 50,000 to 1 lakh crore. In reality, they actually sold, and they sold about 1.66 lakh crore. This one of the basic assumption was us that US market should not do well. Indian equity, the emerging markets should do well. And if emerging markets should do well, India would get its own fair share of allocation, and hence we were expecting to be the FPI to be this one. It did not happen. So there were pluses and there were minuses in our prediction. Let's go into now see how do we see 2026. I must tell you upfront, there are many views floating in the market. They may be right, we may be wrong. Please don't say उसने ये बोला आप ऐसे बोल रहे हो and so and so. We believe what we believe, and that's what we are presenting. We'll appreciate and we respect everyone's opinion, but we don't have any comments on those opinions. So this is our view. Please take it as it is. Again, a disclaimer, not necessarily all prediction will come true, or even one prediction will come true. Okay, these are not prediction of MarketsMojo, but my personal view, how I look at. So please take it with tons of salt. While we have ensured that data are right and correct, not necessarily each and every data that we are presenting would be accurate to that extent. and please consult your financial advisor before buying or selling any assets class or equity or a sector based on this presentation. So let me start with, there are total 8 data points we are going to discuss about it, and let me take one by one, and I'll give it to Mohit from the data point number 6. So first 5 I will take, and then Mohit will do the heavy lifting. All ends well, which ends well. Am I right? All is well that ends well. Yeah. So Mohit would take care of that. So how many rate cuts from RBI? This is a contra view, the way we were having last year. And reason why we are saying so. So what is happening is that we saw 125 bips rate cut coming from the RBI, okay, purely because of there was a inflation was benign, there was a tariff uncertainty, and country needed some amount of a help from the monetary policy. But as we move into 2026, RBI believes that, and we also believe that inflation will start inching up by second half of 2026 because of base effect, and mostly this year may not be a very kind of a good monsoon also, because the SkyMet came out with the initial estimates that monsoon could be below average. You know that IMD came out with this, so there is a 2 kind of monsoon India has, am I right? One is that northeast west monsoon and southwest monsoon. The northeast monsoon is likely to little below par, which happens from Jan to March. Most probably the second half of the monsoon season, that is southwest monsoon, where we might see an El Nino effect. So, and if that happens, what happens? Now it's only a question when it gets sets in. Does it sets in by July end? Does it sets in by August? Does it sets in by September? If it sets in September, then we don't have to worry. But if it happens somewhere by July, then half of the season will have that impact. So that's it's too early to basically make a comment on that. But our base case scenario, possibility of rate cut from RBI this year is very, very low. In fact, we don't expect any kind of a rate cut, because RBI little ahead and did little aggressive rate cuts in 2025. So if you look at it, 65% probability we are saying there will not be any rate cut. There is a 25% probability that there will be a 25 bips rate cut. So if I look to merge these 2 buckets, that is 0 to 25, 90% probability. So do not expect major rate cuts happening from the RBI in 2026. Again, repeat, because of inflation moving up, and I think we are in a very comfort zone in terms of the repo rate. Will crude oil price keep falling? And I think it assumes all the more importance because of what happened in Venezuela, which has the largest oil reserves in the world. Okay, what happened there? Once upon a time in 1970, when I was born, Venezuela used to account for 8% of the total oil production. Today it accounts for less than 1% of the total oil production in the world. So that's what has happened, of course, but there are more things can happen. This is the average crude oil basket. This is India's average crude oil basket. Don't get confused with Brent or WTI. This is India, what India pays dollar per barrel. That's it. It's a total mix of WTI, Brent, and so on and so forth. 3 years in a row, it has come down. It was 97.6 somewhere in 2022. It came down to 69.4 in 2025. There have been instances where 4 years in a row, the crude oil price have come down, which we have seen somewhere from 2013 till 2016. 106 coming down to 97, 51, and so on and so forth. So there have been instances where we have seen the crude oil prices coming down. We expect crude oil prices to remain a little benign in 2026, despite there is a geopolitical situation happening, Venezuela happening, and so on and so forth. So just to give it numbers, $79.8 per barrel in 2024, which came down to $69.40 in 2025. This is the reason has been that there has been more supply than the demand. In fact, the demand fortunately was much higher than what was anticipated in the beginning of 2025, because a lot of people thought that the world economy will not do well. That includes IMD, OECD, World Bank, and so on and so forth. But there are a lot of resilience has been shown by the world economy, and yet the crude oil price have really cracked to 69. One of the reason why, of course, the OPEC has been kept rising production despite the prices falling, because they wanted to regain the market share. And China also played a smart game. What it did basically, it used this for lower prices to build up more inventory. Otherwise, the price would have fallen much further in that sense. IEA, that's the International Agency Energy Association, believes that crude price will be $55 per barrel in 2026. Our analysis suggests that it should be near about $60 per barrel, purely based on the demand and supply. So a lot of people, of course, JP Morgan came out with the statement that crude can go to $30 per barrel by FY 2027. We don't know whether that's going to happen or not. But one thing definitely looks very certain to us, that crude oil price is a structural downward movement. And I think this trend will continue in 2026. What we saw in 2024 coming down to 2025, and it will happen somewhere in 2026. This is the monthly crude oil basket price for India. And if you see, it did move up in the month of June, July, and then again started tapering off purely because of Iran episode which happened. And there was a fear that the Hormuz, the canal of Hormuz will get stopped by Iran, and that really we saw a small spurt in the crude oil price. But then again it started coming down, and we are at 62.26 at the end of December 2025. So our base case scenario again, $50 to $60 per barrel, 65% probability. Below $50 per barrel, we are saying 0% probability. So that's what we believe is going to happen. Will Rupee continue to face pressure? So let's look at what has happened. It's not that Rupee has always depreciated. In fact, if you remember, not many people remember because the human memories are very short. In 2017, Rupee appreciated against the dollar by 6.3%. But on an average, Rupee has depreciated on an average by 3%, despite there is an appreciation of 6.3% in this one. We saw 5% depreciation in Rupee in 2025. We believe there are few factors which are positive for the Rupee. Having said that, we do expect Rupee to depreciate in 2026, but not as much as what we saw in 2025. What are the positive factors? One is definitely crude oil price. India has to buy crude in dollar, and if there is a more pressure on not buying Russian oil, then of course we need to settle in dollar. Am I right? So, but of course the $10 per barrel, we are expecting crude to be declining as compared to what it was the previous year. So that's a benefit. We strongly believe FPI will make a strong comeback, and I'll cover that in my subsequent slides. Number 3, we don't expect Fed to do a rate hike, because that also has an impact on this side. On the contrary, we don't expect any rate cut from Fed. Again, it's a contra call in 2026 because we believe that inflation will get spiked in the US, and if that's so, and despite the new governor which will come in, which is going to replace Jerome Powell, which will be more friendly to the US president, and yet we believe that less likely that Fed is going to do a rate cut in 2026. And of course, and we also expect the imports of gold and silver to taper off in 2026 as compared to what it has been 2025, and that means there is less demand for dollar. And on an average, we are expecting 91 rupees plus or minus 1 by December 2026. So this is what the base case scenario that we are talking about this one. But do we expect Rupee to strengthen in 2026? We are saying probability 0. We don't expect Rupee to strengthen in 2026. We expect Rupee to be somewhere 91 plus or minus in 2026. Another year of FPI outflow, and I think that's a very big question that everyone is this one. So we did some analysis actually, and if you look at this data, we have taken this data since 2002 just to understand how often FPI have been selling in Indian equity market and how many instances. If you look at from 2002 to 2025, that's where the growth in the Indian equity market started, because in 2002, India's index was lower than what it was in 1992, purely because in 1982 we saw the rally because of Harshad Mehta and so on and so forth. So the quantum of money which has started coming from 2002, only 5 years we have seen FPI outflow. But what we observed, as and when this FPI outflows happen, there is a trend there. In 1 year, when there is an FPI outflow has been very strong, the next subsequent year, the inflow is more than the outflow. For example, in 2008, the FPI sold 52,987 crore. In 2009, they basically made up more than what they sold. They basically bought 83,431. That's a net inflow I'm talking about. In 2018, they sold 33,000 crore, but in 2019, they came back very strongly and they invested 1.01 lakh crore. And something similar happened very recently. In 2022, they sold 1.21 lakh crore and they basically reinvested that amount, 1.71 lakh crore, in 2023. In other words, whenever there is a heavy selling in one calendar year, FPI basically makes very strong comeback. Now, but why would they do it this year? Not necessarily that the trend can continue. And there are few reasons which we believe FPI will make a very strong comeback. Number one, growth in India Inc. earnings, and of course this will mainly driven by the large cap as compared to mid and small cap in 2026. Second thing, rupee to remain more stable, because if rupee is depreciating or view on the rupee is a little negative, they always convert that into dollar terms, and if that's the case, they would get less comfortable investing in country like India. And we say rupee to remain more or less more stable as compared to what it was in 2025. Tariff-related uncertainty likely to subside. Of course, yesterday there is a statement from Trump that if India don't stop buying Russian oil, we may increase the tariff, and we believe that the 2026 may not be the as bad as what it was 2025, and that's another reason why FPI. And last but not the least, I think the valuation of the large cap has become more and more reasonable because of growth in earnings, and that's the one reason FPI make a strong comeback. China is another factor which China announces stimulus in 2025, something like cash for clunker kind of a stuff, where you basically buy a new refrigerator or new washing machine and they would give some incentives to buy that. There is little, right at this point of there is little clarity not there whether this will continue in 2026 or not, and hence there could be a slowdown in the Chinese market, and if that is so, the money which was going to the China may come to country like India, and hence we expect near about 1.75 lakh crore inflow from FPI in 2026. This is what our base case scenario, 60% probability that we should see somewhere between 1.5 to 2 lakh crore inflow coming into the Indian equity market. Now coming to the best assets class of 2025, and a lot of people made a lot of money in gold and silver. Again, this time our prediction again a contra call. Okay, of course there are a lot of people saying a lot of data. We always look at these are gold returns every year in a calendar year, and you can see on the 2025 is an outlier by a huge margin. Normally what we have observed that the gold 2 years positive and then 1 year negative, which happened in 2016, 17, 2018 negative, 2019, 20 positive, 2021, 22 negative. This is the third year in a row that gold has given positive returns in dollar terms. Now, will it glitter in 2026? So let me give you some market experts' prediction, and then we'll come to her. The most people believe that gold will extend the rally. Okay, and I'll give you a few names also. The JP Morgan predicted that the gold can go reach $5,000 per ounce, not barrel, in 2026. The Goldman Sachs believes 4,900, very similar to what JP Morgan has stated. Okay. This is another case scenario. If there is a weak dollar and low interest rate, it's basically good for the gold. And there is one more thing which is happening globally, which is the debasement of trade. Basically, where people will invest more into the physical assets, and that is so it's also favorable for the gold. So these are the good things which are favorable for the gold. But we are not bullish on the gold, and a couple of reasons I'll tell you. We don't expect central banks to buying as much gold as what basically they did in 2025. In fact, the last quarter of 2025, the central bank bought less than what they bought in last quarter of 2024. The second thing which will happen is that there is a possibility, there is a sign which is happening. The way we have seen lab-grown diamond, and which really resulted into a fall in the price of natural diamond, who knows? We might see a lab-grown diamond, gold, which can possibly happen. It's just a chemical that has to be done, and if that happens, it could also create some amount of a headwinds for the gold. And anyway, what we have observed that there is a trend that whenever gold has given higher returns, normally the law of average should kick in and it should come down. So we are expecting gold to give a negative or a muted returns in 2026. Having said that, we don't expect gold to crash tomorrow. The way Bitcoin price have happened in 2025, something similar will happen in 2026. In other words, gold can extend the rally. Somewhere by mid of 2026, it can start tapering. And when I look at point to point from 2025 to 2026 end, it could be a muted or a negative returns coming in from the gold. So that's what has happened. And having said that, never ever consider gold and silver having a view on the market, on the price movement, and it's a part of an assets allocation strategy. Am I going to sell my assets allocation of 10 to 15% gold and silver? Answer is no. But as and when the price keeps rising, I'll try to trimming down, bring it down to 15% so that my allocation is right. So please remember, your gold and silver is a function of your assets allocation strategy, and hence because of 1 year price movement, you should not do too much changes in the reason we are saying this information, just that don't be too much go overboard and increase allocation to gold too much and basically takes it beyond 15%, then maybe you are up for a little negative surprise. So what is the probability? 40% negative return and 0 to 5% 30. So basically 70% we are saying that it will give either negative or at the max 5% return from the gold. Let's move to the silver. Again, very similar kind of a trend. So if you look at gold and silver, have a very similar kind of a pattern. But 148% return in a single calendar year is broken all the records. In fact, I've looked at 75 years of data of silver, and not a single year I've seen that silver ne century Mario. It has never ever happened in that the long history of silver. So, again, I looked at the demand supply kind of stuff, because this is all commodity. So 60% of the silver gets consumed by the industrial. When I say industrial, like EV, solar, and so on and so forth. And it's not that your EV only consumes silver, even your ICE vehicle also consumes silver, but uska ratio थोड़ा कम होता है. But the silver do get consumed even in the ICE vehicles also. And of course, the 60% comes from the demand for the silver, comes from the industrial. 18% comes from the jewelry, and also another 18% comes from the investment. The human tendency is that जो assets class चलता है उस पर ज़्यादा पैसा डालना है. That's what the human tendency is, and that was basically so. मोटा 96% of the demand comes from industrial, investment, and jewelry for the silver. Second thing which is happening, which is a positive for the silver, there is a change in the technology is happening in the solar. So within 60%, 28% comes from the solar industry, the demand for the silver. Now there is something called technology called TopCon, okay, which is a little better technology as compared to what is the present technology called PERC. I'm going a little technical just to help you understand, and there is something called SHJ. I've given the definition there, which basically means it increases the efficiency of the solar panel. But since it increases the solar panel, it also asks for more silver component, which is near about 50% or so. Second thing, all our EVs and cars are becoming more and more, advanced in terms of cameras and so on, so sensors. Am I right? Mohit started with Wagon-R and webinar kind of a but all cars are now have a lot of sensors. Higher the sensors, higher the demand for the silver in the car. So that's another positive for the silver. But at the same time, there is one more thing which is coming out, which is called silver coated copper. That is called something called silver oxide, silver coated copper powder. Okay, which is a new technology is coming in, which will reduce the same efficiency or maybe little less than what it is, but it will reduce my cost of the silver component in the solar panel, and that's what is going to happen, which will reduce the demand for the silver. At the same time, despite more solar panel and more EVs and so on and so forth, the reality is that in 2025, the demand for silver from industrial came down by 0.5%. And we believe that will again, because what is the cure for higher price is higher price. Am I right? So somewhere people will see want to find a solution, because 165% appreciation 1 year is going to create some logical replacement demand that's going to come in. So while 2025 has been turned out to be the best year, and before that, 2010 was the best year for silver, which where the price moved up by 70%. Of course, we saw in 2011 the silver price coming down. So our sense is that the law of average should come up. The kind of gain that has been made in 2025 is unlikely to get repeated. And hence, while in gold we have 40% probability of negative returns, here we are saying 75% of silver giving negative returns. I again repeat, the general house, there are various views floating in the market that silver will give extend rally. Again, gold and silver will behave very similar to what happened in bitcoins in 2025. I'm not expecting them to correct tomorrow. So of course, I will keep coming in front of you in various webinars, and there is silver to all बढ़ गया. Of course, it will go further up. But when I look at December to December level, probability is very high that silver will give negative returns with 75% probability. With this, let me hand it over to Mohit, and Mohit will be in a more firing mode as compared to.
So let me just give you a disclaimer out here. These are our personal views. This is not MarketsMojo's views. We are two professionals who have our own views. We are not competing here. We come from maybe a little bit of a different thought process, Sunil and me. And we just want to give you flavor of both the thought process. So, nothing to say that I am going against what Sunil is saying, but I build up my thought process in a little different way in which Sunil has brought up. Although Sunil shared this presentation with me an hour back, but I was busy and I saw it only 15 minutes before the webinar, so I couldn't give counterpoints on my data points to
one data correction 5 घंटे पहले हुआ था, उसके बाद रिवाइज 1 घंटे पहले भेजा था.
Yeah, so and that also he can understand. I went through the presentation with 2 more people sitting in front of me.
Mohit sir is so busy. वो मीटिंग के बाद मीटिंग हो, तारीख के बाद तारीख होता, वैसे मीटिंग के बाद मीटिंग होती उनकी.
So anyway, so I'll tell you where I disagree with this view, but I will first of all give you Sunil's view because that's what this presentation is more about. So is this the comeback year for mid and small cap companies? Let's look at, okay, he's very conveniently removed one slide where I wanted to counter him.
We discussed that. To remove that. Right?
So, okay.
There is nothing.
So, all right. Now what we have done here is that we've looked at the P's of companies which are above 100 in mid cap. So there are 9.2% of companies with a market cap of 10.7. When I say market cap of 10.7, this is market cap of mid cap companies of 10.7. And if you look at 50 to 100, there are 25% companies out there with a market cap of around 26.5% out there. And 30 to 50 is around 34% companies with a market cap of 28.6%. And less than 30 is around 31% of companies which have a market cap of 34.2%. I guess what we are trying to say here is that if you look at versus their historical P's, which is my second data point that I'm going to come to, there is a bit of overpricing that has happened in the mid-cap valuations despite the index not moving very further over the last calendar year. The second data point that has been collaborated is pretty interesting. If you see here, we have taken companies who are today trading at more than 3 years of their own average PE. I repeat, we have taken companies which are trading over their 3-year average PEs. So in this case, 34% of the companies are today trading over their 3-year average PEs, which is typically a 40% of the market cap of the mid-cap companies. Companies which are trading over 5 years of their average PE is 45.1%, which is 52% of the mid-cap market cap, and more than 10 years is around 50% of the companies, which is typically 50.5% of the market cap. Now, the outlook that has been stated out here And I'm just gonna, as I said, I'm going to present what the view is, and then maybe we can have one-on-one with Sunil on this. 2/3 of the BSE mid-cap companies are currently commanding a PE of at least 30. Market cap to GDP ratio of mid-cap is currently 26 compared to 20-year average of 13%. Since many mid-cap companies command rich valuation, there is little scope for margin of safety out there. And hence what we are trying to say here is that mid-caps the index might give a positive return, but it will be a muted return that you can get from mid-caps as compared to the large caps on a broader basis, as we'll come towards the index projection of the Nifty. Last 5 years CAGR of the mid-cap index has been 21%. Now let's do a similar analysis of small caps. If you look at the correction, as Sunil pointed out, that the small caps have delivered a negative 6% return over the last year. If you look at, despite that particular correction, small cap valuations are rich. Over 100 PE, there are 16% of companies, a market cap of 8.7% of the small cap companies. 50 to 100, 14.2 with a market cap of 22.9%, and 30 to 50 is around 21% of the companies with a market cap of 26.6%. But less than 30, there are around 50%, almost 48% of the companies which have a market cap of 41.8%. So there is less than 30, which is typically, we would call as round about the average or below average. There are around still 48% of the companies which have got a market cap of around 48.8%, and remaining of the companies are typically up in the range of 30 and above. Having said that, if you look at companies in the small cap sector, small cap segment, which typically are more than 3-year average PE, there are 37% of the companies with a market cap of 45%. More than 5-year average PE, 45.7% with 52.7% of the market cap. And if you look at 10-year average PE, there are 52% of the companies which are trading above the 10-year average PE with a market cap of 59.3%. Again, if we are looking at the outlook presented out here, the market cap to GDP ratio of small cap companies is around 27% compared to the 20-year average of around 11%. Despite 2025 negative returns in the index last year has given, if you see the last 5 years, we've got an absolute of 184% returns, which is typically a CAGR for the small cap index at around 23%. PE distribution of small cap companies show that nearly 60% of the companies are commanding PE of more than 30 times. Our sense is that 2026 will be more of the large cap compared to mid and small caps. Hence, we expect muted returns from small caps in 2026. Let's look at now Nifty 50. 10 year of positive returns. If you see here, we've had, although this has not been a 50%, 60% year that we saw prior to 2016, but if you see from 2016 onwards to 2025, you would typically see returns of 3%, 29%, 3%, 12%, 15, 24%, 4%, 20%, 9%, and 11%. Are we saying that we will be the 11th year in a row where Nifty could deliver a positive return? Now, we have done various data points with you on macros, on sectors, in fact on companies as well. But if you look at the top 5 reasons that we are talking about, the last incidence of Nifty delivering negative returns was in the calendar year 2015. That's number 1. Despite the stock market performance, since the valuation even today does not appear to be stretched. Nifty's CAGR from 2015 onwards to 2025, which is a 10-year period, is at a 12.5%, which is normally a moderate kind of a number. Normally speaking, historically, when we have seen that there is a correction that has come on Nifty, it is after a very rapid growth that we have seen that the market has done, and then there is a bit of a relaxation in the market where you've seen money being drawn out because of profit booking or FPIs taking out money, but that is not the case last year. So there is no sense of expecting a large amount of profit booking out there. Market corrections typically have been periods of very, very rapid price escalation, but that is not something that we've seen, especially in the last 2-3 years. Earnings growth, as we said, 2015 early part was a little muted, 2025, but last quarter we saw a good glimpse of earnings growth coming in. We expect a good earnings growth in 2026, which supports our hypothesis of where Nifty could end on 31st of December 2026. Against this particular backdrop, our prediction is that Nifty could deliver a 15 to 20% return in this calendar year from 1st of Jan 2026 to 31st December 2026. So if you look at the broad hypothesis out here, there is no bubble out here. So there is no reason for the index to crash out there. I think the index delivering 11% with gold delivering 60% plus and silver delivering 147% plus, with the kind of depreciation that we saw in this particular year, with the kind of geopolitical situations we saw, with the kind of tariff impact that we saw, there's a lot of bangs and hits that we've taken in this particular year. But this is a sign of actually pricing in all of that negative news. So there is no bubble that we see that there are very, very high valuations or earnings are tapering down. So none of those incidences are visible in the current market outlook. So if you look at previous bull markets, shows a CAGR. If you look at the combination of previous bull markets, it talks about a CAGR of closer to 20%. 2002 to 2007 period, they delivered an exceptional 34% CAGRs, and before the subsequent corrections out here. The measured pace, this is what it shows in typically more like developed markets. When you see consecutive 3%, 2% up, 5% up, 10% up, and all this stuff, it basically talks about that the price appreciation is becoming more and more fundamental and earnings driven, and the froth of the market is not delivering any kind of a consequence in the market. It is becoming much more stronger, fundamental driven kind of a market, which is what we are seeing here. 2002 to 2007, as I said, was a continuous gain of 6 years, where the CAGR, Nifty CAGR was 34%. The next year fall was around 51.8%. If you look at the second period, which is 2009 to 2010, which was a 2-year period, Nifty CAGR was 44%, then ended up the next year fall at 24%. Subsequently, if you see 2012 to 2014, which is 3-year period, Nifty CAGR is 21.4%, and there was a subsequent fall of 4%. And if you look at today, where we are sitting at 10-year period, the CAGRs are subdued, which is 12.6%. I would say it's a very moderate CAGR number over the last 10 years. And what are we expecting over the next year? Now, we personally believe that we would be in a 15 to 20% kind of a range with a 55% probability, 20 to 30% with a 10% probability. We don't see anything above 30%. Between 0 to 15%, which is a wide range, which is market being slightly flattish to a little bit positive, or maybe it can be higher teens as well, is around 25%. And Nifty going negative this year, our probability is 10%. So we are personally in the, broadly speaking, if you see close to 80% of our probability is in between 0 to 20%. And out of that, majority of it, which is almost 80% of that 100%, or maybe 55% of the total, is typically in the 15 to 20% probability. There is this interesting data that you see out here. So there has been a year which is 2025, which is a little bit of an exceptional year. Show this slide as much as you can, please. So if you look at 2025, Sensex delivered 9%, Nifty delivered 11%, and unlike what usually happens, mid caps delivered 1% and small caps delivered a negative 7%. Most of the years, if you see 2024 with 8 and 9%, or I would maybe look at only one. Let's look at only Nifty. It just makes it a little more easier. If you look at 9%, mid cap delivered 26 and small caps delivered 29%. If you look at 2023 with a 20%, 46% and 48%. Then again, we had a little bit of a flattish year, 2022, 4%, 1%, but not that negative at a -2%. Whenever you look at a higher teen number, apart from the year 2019, which is a 12% return with mid caps -3% and small caps -7%. And 2018, which is 3% versus mid cap -13% and small caps at a -24%. So if I look at a 10-year period, there's been 3 or 4 instances out here where actually the large caps, which is typically I assume as Nifty, has given better returns than mid and small cap. In fact, sometimes in positive, where mid and small caps even are in negative. And this is where the, can I have the screen please? This is where my disconnect comes in with Sunil. And I'll tell you why is this disconnect. And I'm not going to have a fist fight with Sunil. We'll do this after the webinar.
I cannot win actually.
He does cardio in the gym, I do weights. So. But I'll tell you, I'll give you my view and then maybe Sunil can.
I think what I request you first complete the presentation and then we can go to the discussion mode.
All right. So, okay. So let's just look at the strategy for 2026. Despite whatever we say, whether mid caps will do well or small caps will do well, I think what we're saying is broader markets is typically something that should do well, which is in the range of 15 to 20%. Our view on other asset classes is something that we've already said, that gold can be in a maybe plus 5%, 10% kind of a zone, and silver you can expect a correction out there, which means that you need to be very clear about your asset allocation. When we are talking about and not large appreciation on gold, don't start selling gold. Gold always needs to be a part of your allocation. We've always propagated a 10, sometimes even a 15% allocation towards gold. So you need to always make sure that you're following that. The view is that the mid and small cap, even if the view that Sunil is saying is comes true, you have to be very selective out there, because in both mid and small cap, and I would say, and that's one of the data points that I'm going to ask Sunil, which we can present later on. But I personally believe you still have 40-50% companies which are trading below their 5-year, 3-year, and 10-year averages. So you still have a chance to looking at those particular companies. Sectors will be very paramount. So sectors that we are looking at, consumption and exports oriented sectors should do reasonably well due to government tax benefits, tariff related uncertainty abating, and rupee depreciation. Those are things that I think on the sector side that we're saying, but obviously we can cover that in detail later on. So what should be your strategy? Gold and silver should be a part of asset allocation, and request not to outboard them completely. You may want to align it. You may want to, as we say, get your allocations in place. But this is not the time to try and say that aisa ban gaya, so let's make it zero. Jab niche aa jayega, to I'll again buy. This is not the strategy that you adopt. You basically say that, can I maybe trim my positions and get back to my strategic allocation, or do I need to retain my allocations? At what time I need to align myself out there? But this is not the time to completely offboard them as an allocation. Geopolitical uncertainty will remain high in 2026, but we've seen enough with what's happening with US and Venezuela out here, and the market's hardly reacting out there. But these can be temporary, but you will see a lot of these issues that will happen even in this year. The best thing to do out there is to have a portfolio when you have a broader market confident strategy, which is typically that markets will do well, but you cannot today take a view that I will create a large cap portfolio or I'll only create a mid cap or a small cap portfolio. I think well diversified portfolios that gives you ability to hedge the risk a little, but also gives you alpha opportunities provided anything goes well, are a great approach. It is going to be a tough market if you are a stock picker. So if you are a stock picker, which is you are managing your own portfolios by picking up stocks and getting out of the stocks, it is going to be a tough year unless you are taking a very disciplined approach on portfolios, which is a well managed portfolio. So hence, professionally managed portfolios, whether with us or with anybody else, according to me, are likely to do better due to better understanding for fund managers and the CIOs like Sunil on the market dynamics. Okay, before we get into this, we have this 14,999 offer, which you pay for 1 year. You're getting 1 year off Mojo One in Stock of the Week, absolutely free. This is a very limited day offer, a limited time offer that we're doing. You're getting a huge 79% discount, and for a few hours we are extending this particular offer, which is 19,999, where you pay for 1 year, but you get 2 years free, and you get the whole of US free as well. So this is India plus US. For 3 years, you only pay 19,999. A lot of you have come back to us, and my customer service team is this thing that I was a webinar attendee, but I bought it from the site, so मेरे को offer नहीं मिला. This is only for webinar attendees. You do not try and find this offer on the site. It is only available through the links that are available down out there. And please make sure that you would have subscribed. You can extend this multiple times as well. All right.
Let's have the focus now.
Let's have the focus now. So I'll just briefly give in my disagreements, and it's a time for you to ask questions. Me and Sunil, as we said, that we can sort out our disagreements outside. My personal view is that if the FPI flow is expected to be 1,60,000 and above kind of a crores, the market is very shallow. The index through which they will come in, or if they come in through passive or active, there is no way they can deploy these funds without a good mid-cap rally, because the market penetration is not that. That's point number one, and I'm not going to do it out there. Any given market scenario, if you see the data that we presented out there, where you have 30, 40, 50% of the companies that are below the average, and 30, 40, 50 companies that are above the average. According to me, that's a normal scenario. That's not an exceptional scenario, and we will dig in a little bit detail on that. I don't want to challenge Sunil because most of the time he's proven me wrong. But having said that, I personally feel that market वैसे ही है कि 50% of the companies are expensive, 50% of the companies are not that expensive. But the fix that a fund manager has is that ये जो expensive होता है, sometimes it keeps re-rating itself and keeps becoming expensive and continues that particular cycle because the earnings are very good, right? So if the earnings are keep coming superlative, then it is very good. So they keep coming in out there. But even one of the data points that we will look at is that what is the same hypothesis that we did for mid and small cap, what is that hypothesis on large cap? Is it that even in large cap, 30, 40, 50% of the companies are above their 5-year P? Then the case is a neutral case, right? Because then, we are in the same base. We are basically saying, combine all these three buggers together, which is large, mid, and small. 50% company average से ऊपर है, 50% नीचे हैं. Level base to play, unless you say that 70% of the companies are below the base, and hence there is a valuation gap out there, which is something that we can only look at once we collaborate that data. So that's my point number 2. Point number 3, that I personally believe that a little bit of a view change that I have is that according to me, gold may continue the rally by 10-15%. I think what is happening is, classically in early 1900s, if you see what happened was that you had the the world wanted to create a parallel currency, and it was known as the gold standard. You should study about the gold standard. Gold standard typically comes in, and that obviously led into Great Depression as well. But gold standard, you should typically see where companies' belief towards each other goes away, countries' belief. Then they try and accumulate one asset class, which typically can be traded at any given point in time without currency pressures. So there is a lot of underlying current from China trying to hoard in the gold reserves, primarily because they want to offset dollar as the primary currency, or they want to hedge against dollar as the primary currency. So that impact, according to me, is not fully factored in. I may see, I'll definitely not see a 60-70%. I may see a 15-20%, on gold still in this particular year, because according to me, that till the time this geopolitical situation settles down, till the time the countries start relying on each other, till the time the cross-border trades become easier, till the time the currencies exchange becomes much more easier, I think gold will be a little more in demand. So these are my 3-4 counterpoints. With that, we will move on to you, because we are here for you, not for ourselves.
Okay, I'll start off with this first question. This is by Sarang. After the gold-silver great rally in 2025, can we expect huge rally in copper, especially because of supply side shortages in mines like Indonesia and more? I think the similar question was asked earlier, but I request you to pick it again.
We remember, Sarang, you had asked this question, or a similar question was asked before, right?
I think what we stated in our power series, I think the answer remains the same. I think demand and supply. So one joker in the pack continues to remain China, and we don't know whether China is going to offer the stimulus again this year for that cash for clunker kind of stuff. And we believe that the copper has also run up too much. So the demand supply scenario makes us believe that yes, there will be a disruption to some extent, but I think it will be taken care of. I don't see much of a problem. So our sense is that copper may go up. It's not that we don't have a in-house view on the copper per se. But is it going to be next silver in the making? The answer is no. Is it going to be next gold in the making? Answer is no. Okay, so that's what we are saying. But if you want, we can do a complete detailed analysis the way we did for gold and silver, to give you a bifurcation like which sector which will drive demand for copper and so on and so forth, and give you. But our sense is that copper, if petrol is to go up maybe 10 to 15%, right now this is off the cuff kind of a number, but we can come back to with more detailed analysis on copper with the proper analysis on demand and supply.
Okay, this next question by SS Namdari. What are your views on continuation of Trump creating geopolitical plus economic disruptions worldwide, including in USA? Can we rule out World War III? What are the chances of China plus Russia challenging him?
Which sir is the best person to answer that?
I think the days are counted, if you ask me. That's my personal view. I think he's trying to disrupt much more than he can handle. With UN coming into picture, obviously Supreme Court of US trying to have the verdict. I think there are too many things that are happening at the same time. I personally don't believe that this is a World War III situation, because this is still very controlled. And according to me, we will not be able to see a World War III. We will not live to see a World War III, because every country is sitting with a nuclear weapon. So there is, with a finish all kind of a tool with every country, nobody is going to use that. That is something which is my personal views. I personally feel that we may have a situation which may be Trump easy in this particular.
What did you say, sorry?
Trump easy.
Trump easy.
If I say Trump free, people will say, "Arey, ye kya bol rahe hai?" So Trump easy in the sense that the impact of Trump is going to come down.
Okay. In fact, I was reading one nice blog which says do's and don'ts don't apply to Don.
Okay, I'll move on to this next question by Vasudevan. Just want to know, how do you arrive at the probability percentage that you present in this webinar? Is it your own personal view?
Yeah, it's our own personal view. So what we have done actually, we have looked at a lot of data. We looked at data and see where there is nothing called 100% surety, am I right? And in fact, couple of years we used to say 100% probability, and then we had a lot of backfire from you people, and I remember once we said that Nifty will go to this level. It did touch him, but next day it did not happen. He said, तुमने बोला था, हमने purchase ही नहीं किया. So we removed that also the low side. But it's a personal view, and we have taken a lot of data analysis to arrive at the probability. Okay, where do we see and how it's going to see? So it's a personal and based on the data science.
Okay, this next question by Amitabh. As per your views, out of the 5, which Infinity portfolio is likely to do better in 2026?
Difficult to say, but if you see, let's look at what has happened so far. I think our top performing portfolio today is the, and I'm not going to give numbers out, is the large cap opportunities. The second is the early discovery, or no, the second is ultra aggressive, and then is early discovery. Difference is not very high. I personally believe the best Infinity portfolio will be something which is not very market cap specific. It should be a very open strategy which can help me move around the market caps. And there are 2 strategies which help me move around all market caps. So if you see the large cap strategy, it's only the large cap strategy. You pay the risk of large cap, whether it's good, bad, whatever it is. A small cap is a small cap strategy. You play it in a small cap fashion. And a mid cap is a mid cap strategy. So one is that you have allocation to all these 3 strategies. And you are diversified at your level. But if you want to look at one portfolio or 2 portfolios, I think ultra aggressive and early discovery are portfolios which plays very nicely 0 to 100% of market caps of large, small, and mid. And it plays across sectors and it plays across strategies of momentum, of turnaround, and all this. So for me, the flexibility and the freedom to play around a strategy is much higher in ultra aggressive and in these 2. And if you were to look at doing asset allocation at your level itself, then you can have a very dedicated large cap, mid cap, and small cap strategy. But having said that, this all also depends on what risk profile you come. This all depends on what is the asset allocation that you have. So all of that is this, what I'm saying is very generic. If you are an individual, we do not know what your risk profiling is, what your KYC is. We don't know you as an investor. We don't know your asset liability mix. We don't know what risk profile you come in. It's better to take the whole risk profiling within the Infinity portfolios and then decide what you can do.
If I can add to that, if I have to extend from 5 to 7, then I think the PMS should do better than the Infinity in 2026.
Yeah.
Okay, moving to this question by Mr. Frank. Greetings, Mohit and Sunil. You are known for finding alpha through common sense analysis. In a market currently influenced by heavy SIP flows and global geopolitical tensions, what is the one common sense indicator you are watching that most retail investors are ignoring? The Nifty PSU Bank Index just hit a fresh record high this week, supported by 12% credit growth. However, deposit growth lagged at 9.4%. How long can these banks sustain this rally before they face a margin squeeze or a liquidity crunch?
So, Frank, last Friday I was with our PMS customer and I said the same thing. Deposit is a raw material for the banks, and if there is a short supply, मेरा finished goods नहीं आएगा. So I think it's a concern, and if you look at the credit deposit ratio for the banking sector, it is 79%. I think it's an area of concern, and in fact, I don't know whether you minutely close, but observe that the sector that I talked about the sectors which are going to do well in 2026. Are one which are domestic consumption and export driven. So there was reason why BFSI was not mentioned there. But last year, same time, we did mention BFSI as a segment. So I think there is a concern. And yesterday, RBI had a meeting with banks and NBFCs and shown little concern about the quality of books that they have been building up. So it is a concern, I think, in terms of this one. And I think one common, and of course, I'll also ask Mohit, because what is the common sense that you're watching most retailers are ignoring. I think the problem, the common sense says that buy low and sell high. That's a common sense, am I right? And retail investors keep doing every time again and again. They keep doing the same mistake again and again, and they pay the very heavy price. And we have seen that happening even in 2025. So I think it's again the herd mentality और जो चल रहा है वो चलता रहेगा. I think that's a common. If you ask, I go for morning walk and of course there's a stop now. It's been come down little less. Otherwise, everyone wanted to buy in gold and silver. In fact, in my PMS webinar also, everyone would wanted to know, is it a right time to increase allocation to gold and silver? And I see that now question coming down. But I think so recency bias, one mistake or common sense that I think everyone keep repeating again and keep losing money based on that. With you?
Yeah, I have only one common sense parameter, which is earnings growth. I personally believe that the price sooner or later either discounts or comes in with the earnings growth parameter. And I think that if you are a fundamental investor and you keep investing in companies which have solid quality and solid earnings growth, even if you get beaten down in a year or two, the bounce back of such companies is phenomenal. So one of the things that people don't look at is they look at the stock, they don't look at the company, which is a very, very big difference. When you look at a stock, the main thing that you look at a stock, you will look at the price of the stock, you will say, isne 1 year, 6 months, what is the kind of return that you've seen on that stock. And this is something that was taught to me by one of the best investors in this country, which has ever produced, that don't look at a stock, look at the company. Look at the fundamentals of the company and forget about the price. Because price sooner or later will come in. If there is a historical evidence that the company has performed, historical evidence that the price has rewarded the company for the performance, and if it is not rewarding today but the company is still performing very well, sooner or later the price will come in. So I think that lays down to the whole game of patience, and it's a very, very patience and ability to stomach volatility is a very, very rare attribute of a human being in equity markets. Because whatever investors say, I don't believe. Because I've seen investors coming for 2 months into a portfolio and they say, "Arey, mera 2 mahine mein paisa nahi ban raha hai." These are the same investors. When you meet them, they will sing songs of 5 years. 5 years, 10 years, sir, ये तो पैसा मेरे को हाथ ही नहीं लगाना है. Then in 2 months, as you say, they strip down from their reality of who they are. So if you have a belief that you've got a tool like MarketsMojo where you are always investing in fundamentally strong companies, then there should be no fear even if your portfolios have a little drawdown or they have not performed very well, because you say that market agar fundamental strong companies ko perform nahi kar rahi hai abhi, then so is the game, right? So my single parameter is if the earnings growth is coming in, if the earnings growth is good, then I have very, very strong belief that whether money comes in, doesn't come in, but sooner or later it will compensate, because return is a contribution of 3-year CAGR. Apan dekhte hain 5-year CAGR. We've seen the chart. Which year the return has been linear? Never been a linear. Whether you talk about 12% over last 5 years or 10 years or whatever it is, right? You will get a 50% year, but you will get a 10% negative year. But your CAGR, if you're looking at, people should start looking at not yearly returns, but their CAGR returns. But for CAGR, for you to, or for anybody to understand CAGR, they have to be there for 3-4 years. It's like a client coming to us and saying that, sir, आप मेरा portfolio 6 महीना पुराना, मेरा CAGR कितना है? So
वो basic concept ही बता है.
1 साल से ऊपर जब तक नहीं जाएगा तो CAGR बनता ही नहीं है सर, फॉर्मूला ही नहीं बनता उसका. So
the CAGR stands for compounded annual growth rate.
So earnings is my guru.
Okay, I'll pick this next question by Rajkumar. Dear Dr. Mohit, I'm calling Dr. Mohit because I know what it takes to earn a doctorate. I have been an Eklavya member of MarketsMojo for more than a year. So yesterday's webinar was an eye-opener for me, which I viewed on YouTube at 10 p.m. I could not take advantage of your 1+2 year offer of 14.9. I want to graduate to Arjuna if you open the link for 15 minutes. After today's webinar closes, I decided to take the pack 2 times for 6 years.
Every day I close this, and next day when I come a webinar, you ask for the same thing again. Okay, now I'm not doing this because of the praises that you've told me, but I'm doing this because of you told me how hard it is to have a doctorate.
He's also a doctor.
Yeah. So how hard it is to get a doctorate. So Jason, please give them a link for 2 years free. 14,999 for 1 year, but you get 2 years free. We'll open that offer and we'll not open it up for 15 minutes as you had requested, Rajkumarji. We will open it up till midnight, but we'll again close it out in the midnight. And I request anybody who's missed out to please take this. I will not be doing this every day, so we'll open it up today. Please see the link. Please don't go on the site. You will not get it. Don't call my customer service that मेरे को तो 6 महीना मिल गया webinar पे there was a 2-year free. So all of that is only a webinar offer because you are a part of this webinar closed group offer. So please use the link that is there under this webinar link.
Okay, Mr. Mood and Sunil, that's it with the Q&A session.
All right, thank you so much. Thank you, Sunil, for such a beautiful presentation.
पर द प्रॉमिस जो मोहित साहब ने जो सवाल पूछे उसका जवाब तो देना पड़ेगा. The next power series will come with all the data points
and we will
debate. We'll debate.
Yeah,
so the good culture we have in MarketsMojo is that everyone is equal when it comes to debate and discussion.
No, it is a very
democratic setup. So
disadvantage point because he prepared for 2 weeks and he showed me 15 minutes before. Yeah, he's right. He sent it to me in the morning 5 years back, but I was busy. But I came unprepared in the presentation. Now I'll be prepared as well.
Thank you everyone for taking time out. Wish you again Happy New Year and take care. I think year 2025 was the year for gold and silver. 2026 looks to be a year for large cap. Please be reasonable expectation from the gold and silver. Again, we repeat just a disclaimer that we don't expect gold and silver to crash by tomorrow. It will go up further from this level. It can go up from this level, but point to point probability is very high that gold and silver may give either muted or a negative returns. Thanks a lot.
And just that this is our personal views. This is not a MarketsMojo views. This is Sunil and Mohit's personal view. So please make sure that you take, as Sunil said, tons of salt. Thank you so much.
Thank you.